Hi there, my name is Dan Malone. You're very welcome to the channel, and today we're going to be discussing how you can go about investing during a recession as someone who has very little prior experience. Why am I making this video? As of recording, many economists are warning of an impending recession in both the US and Europe. In fact, some say that a recession is now virtually guaranteed. Chances are that for many of you watching in the future, we're already in a recession. And if you're concerned about how the recession will impact you financially, trust me, you're not alone. Recessions are scary. You might be worried about your job security, about paying bills or meeting mortgage repayments, or just about what to do with your money in general. That's totally normal, and the fact that you're watching a video about how you can make your money work for you during a recession is an achievement in itself. So congrats. Just so there's no surprises or unmet expectations, here's what we're going to cover in this video. We're going to start off by quickly defining what a recession is and the characteristics of a recession which impact the investing world. We'll talk about what I think are the investments to avoid during a recession, and we'll also talk about the importance of your emergency fund as an investment. Then we'll discuss 3 types of investments which I believe are most suitable for a recession. And finally, we'll conclude by giving some final thoughts about investing for the long term. If at any time you want to skip ahead to another section of the video, you can do so using the timestamps below. But I would encourage you to watch the entire way through. So if that all sounds good to you, then let's get started. Alright, so first off, let's briefly talk about what a recession is and the characteristics of a recession. According to the National Bureau of Economic Research, a recession is defined as a significant decline in economic activity that is spread across the economy and that lasts more than a few months. So the key here is a decline in economic activity, meaning that there's less goods and services being produced, bought and sold in the economy. This can happen for any number of reasons. A sudden shock to the economy, which we saw in 2020 with the pandemic, or an increase in interest rates by central banks to slow inflation, which we're seeing today. In terms of the characteristics of a recession, Forbes notes that during a recession, a nation's economy experiences negative gross domestic product, or GDP, rising levels of unemployment, falling retail sales, and contracting measures of income and manufacturing for an extended period of time. In other words, companies are selling less, there's less jobs, and lower incomes. All of these factors have an impact not only on us as individuals, but on the investing world itself. And therefore, we need to think differently about the investments we make during recessions, which is the point of this video. How does a recession impact company stock prices? Well, the price of every stock on the stock market is based on what the market expects the company to earn in the future. During a recession, those expectations get lowered because companies are selling less and it's typically costing companies more to borrow money, which limits their growth potential. But what's really important to understand is that recessions are considered an unavoidable part of the business cycle. In other words, recessions are a necessary evil in the grand calculus of the economy. And while they might seem and sound scary, they're perfectly normal and don't last forever. This graph shows us all the different recessions the US has experienced since 1948, how long they've lasted, and the unemployment rate during those periods. As you can see, the longest recession was the Great Recession between 07 and 09, which lasted for 18 months. More recently, the 2020 recession only lasted for 2 months, the shortest recession in history, but also had the highest unemployment rate of any recession since 1948. Point being, recessions come in all different shapes and sizes, but they don't last forever, with the average recession lasting between 6 and 12 months. With that in mind, let's talk about the investments you should avoid during a recession. First up are speculative investments. What are speculative investments? A speculative investment is one where money is put into a stock or cryptocurrency with the sole expectation of seeing a significant increase in the value of that investment in the short term. They're considered to be high risk, high reward investments, and when you make them, you don't really care about the performance of the company in the case of stocks or the utility of the coin in the case of cryptocurrencies. All you care about is the potential for the price of the investment to increase significantly. What the investment actually represents is irrelevant. These kinds of investments were all the rage during 2020 and 2021. GameStop, special purpose acquisition companies, meme coins, penny stocks. In each of these cases, what the investment actually represented didn't matter. It's just the fact that they were popular online, which made them an attractive investment opportunity for those looking to make a quick dollar. But in reality, most people who bought into these investments ended up losing money. You should just stay away from these kinds of investments in general, let alone during a recession. Bottom line, this kind of investing is actually more akin to gambling, and it's definitely something to be avoided when times are tough. There's also something to be said for avoiding so-called growth stocks during a recession. These are companies which typically have very little in the way of earnings today, but the market is expecting them to be the big winners of the future. Examples might include the likes of Roku or Teladoc, both of which have seen massive stock losses as of late. The reason why you'd want to avoid these kinds of companies during a recession is twofold. First of all, interest rates are higher, which negatively impacts company stock prices across the board. But because so much of the value of growth stocks is predicated on future earnings, these kinds of stocks are most negatively impacted by rising interest rates. And that comes down to how the market calculates stock prices, which is through a discounted cash flow pricing model. So in a recession, simply by virtue of how stock prices are calculated, growth stocks are going to be more volatile and should be avoided. But the second reason why growth stocks should be avoided during a recession is because their backs are up against the wall. It's more expensive to borrow money because of higher rates, which limits the company's growth. Plus, any existing debt which the company had before interest rates were increased just became much more expensive. So for a company who isn't turning a profit in a non-recessionary climate, the recession really puts their survival at risk, especially when you consider that consumers are spending less money. Just some food for thought. Next up are highly leveraged investments. The term leverage just refers to the use of debt or borrowed money either by yourself in the making of the investment or by the company or investment product in which you're investing. Whenever borrowed money is involved in an investment, there's always a heightened risk of loss, but equally, there's always a greater potential for gain. It's typically advisable to avoid borrowing money to make investments during a recession, simply because the economic uncertainty of a recession can make stock prices extra volatile. You don't want to be in a position where a stock which you've invested in falls by 10% and that loss then gets amplified even more because you've used borrowed money to make that investment. You'll notice that a common theme of this section of the video is avoiding losing money as much as possible during a recession. Equally, you'll want to avoid investing in companies that have too much debt on their balance sheet. And you'll also want to avoid investment products like leveraged ETFs, which use borrowed money to try and amplify the investment returns which they provide to investors. Lastly, there's cyclical investments. Cyclical investments typically refer to companies whose financial performance is tied to the health of the economy. In other words, in boom times, cyclical investments perform well. In recessionary times, cyclical investments perform poorly. So what type of companies would be considered as cyclical investments? The big one is discretionary spending. Travel, restaurant chains, hotels, entertainment. Companies who specialize in providing goods and services which consumers would be most likely to cut out of their spending plans during a recession. There was a recent survey in the States which asked consumers which expenses they'd be most likely to cut back on if prices continue to rise. Look at the results. These are all discretionary items. So therefore, in a recession, it's probably wise to avoid cyclical investments, at least at the beginning or until such a time where the market is being overly pessimistic about their future. So now that we've discussed the investments to avoid, let's talk about the investments to prioritize during a recession. First up is your emergency fund. Now, I know what you're thinking. Isn't an emergency fund just cash in a bank account? Can that really be considered as an investment? And you'd be correct for thinking that way. In fact, in the past, we've emphasized multiple times that leaving lots of cash in the bank is perhaps one of the most surefire ways to lose money over the long term. So why am I recommending it? Well, because during a recession, things are a bit different. Earlier we mentioned that recessions are characterized by rising levels of unemployment and lower incomes. In other words, job security and salary security are low. If you were to lose your job or receive a pay cut, you'd naturally have less money coming in on a monthly basis, but you'd still have to come up with the cash to cover your expenses. That's why during recessions, more than any other time, emergency funds are so important. You need to have enough cash there to cover yourself in the event of an emergency. That begs the question, how much cash should you have? The general rule of thumb is to have 3 to 6 months worth of expenses in your emergency fund. In a recession, you'd probably want to be getting closer to the 6-month mark, if not more if you think it's necessary. For example, someone in a secure job who still lives at home would likely have less of a need for a large emergency fund as compared to someone in a not so secure job who is renting or paying off their mortgage. It just comes down to your own personal circumstances. After we've satisfied ourselves that our emergency fund is sufficient, we can then start looking at actual investments to make during a recession. The first investment I want to cover is index funds. What is an index fund? An index fund is an investment product which you can invest in, and by doing so, it will allow you to own many different stocks which are being tracked by a particular stock market index. Take the S&P 500 as an example. The S&P 500 is what's known as a stock market index, and its purpose is to measure the stock performance of the 500 largest companies in the United States. Investors from all over the world use this measure as a gauge for the US economy as a whole. Way back in the 1970s, a man named John Bogle, who was the founder of Vanguard, decided that he was going to make an investment product which would allow average investors to own all of the 500 stocks in the S&P 500 at the same time through one quick, simple and cost-efficient investment. This was known as an S&P 500 index fund. But the S&P 500 is just one particular stock market index, and nowadays there are lots of indexes which track different segments of the stock market all around the world. North America, Europe, emerging markets, all world, the list goes on. Likewise, there are lots of index funds which will allow you to own the stocks which those indexes track. Index funds are a fantastic investment to own, not only during a recession, but all of the time. They allow you to own hundreds of different stocks at once, which avoids the risk of having all your money invested in one single company. And as we talked about earlier, the economic uncertainty which exists during a recession can make the stock market quite volatile. So spreading out your investment across many different companies is very important, and index funds allow you to do that easily. Plus, with index funds that cover the largest companies in geographic regions like North America or Europe, you're effectively betting on both the US and Eurozone economies recovering from the recession, which historically has been a safe bet to make. The other benefit of index fund investing is that it requires a fraction of the research that individual stock investing requires. Reason being, beyond understanding what type of stocks are included within the fund and the fees which the fund charges, there isn't a lot of extra research required before investing. Whereas when you're looking at an individual company, you have to consider its financial performance, its market, its future prospects, etc., etc. Essentially, saving yourself time so that you can focus on more important money matters like covering expenses. So how do you go about investing in index funds? The easiest way to do it is to invest in an exchange traded fund, or ETF, which is also an index fund, because not all ETFs are index funds. Shares of ETFs are bought and sold on the stock market just like a regular company stock, meaning all you need is an online brokerage account to access them. This makes index fund ETFs very accessible investments. If you want to learn more about ETFs specifically, check out the video popping up on screen now. The second investment I want to cover is dividend stocks. The reason why owning good, reliable, dividend-paying stocks is a smart idea during a recession is twofold. First off, we mentioned earlier that recessions typically result in lower incomes. Therefore, by investing in dividend-paying stocks, you're at least supplementing some of that lost income, albeit by a small percentage depending on the size of the investment. But secondly, by investing in dividend stocks, we're guaranteeing ourselves some form of regular realized return on investment, even when stock prices aren't increasing or are even decreasing. Remember, investors make money on the stock market through both capital appreciation, i.e. increases in the price of the stock, or through dividends. In recessionary periods, it's likely that many of your investments will see little returns in the form of capital appreciation. That's because the economic conditions have weighed down on financial performance and investor sentiment, and as a result, stock prices suffer. So dividends allow us to see some form of return from our investment during a recession. That begs the question, which dividend stocks should you invest in? We recently made a video covering dividend stock investing in detail, so definitely check that out after this video. But the two most important features to look out for in a high quality dividend stock are consistency and scalability. Consistency meaning that the company has a long track record of paying dividends, and scalability meaning that the company has been increasing its dividends over time as well. With that in mind, the best place to start looking for dividend stocks to invest in during a recession is the list of dividend kings. The Dividend Kings list is made up of S&P 500 member companies who have increased their dividend each year for at least 50 consecutive years. That means that the companies on this list have increased their dividend and remained consistent with their dividend throughout the 1987 stock market crash, the dot-com bubble, the Great Recession of 08-09, and the global pandemic. They've proved time and time again that they're reliable, recession-proof investments, and I'd wager that they'd be a safe bet this time around too. But don't make the mistake of investing in any old dividend paying stock. Many investors think that investing in the stocks which pay the highest dividend relative to their stock price is the best thing to do. That's what's known as a dividend yield trap. You see, dividends aren't guaranteed, and just like how poor financial performance during recessions can hurt the stock price, they can also hurt the dividend, because the management team of the company may be forced to reduce the dividend in order to survive. So that's why investing in high quality dividend kings is a good idea. But if you are going to invest in dividend stocks more broadly, three key metrics to look out for when assessing their quality are the dividend yield, the dividend payout ratio, and the average free cash flow of the company. Dividend yield tells you what kind of bang for your buck you're getting by investing in a particular dividend paying stock. The dividend payout ratio tells you how much of a dividend a company is paying out relative to its earnings. And the average free cash flow of the company gives you an indication of whether the company has more than enough cash to cover its dividend payment. The third investment I want to cover is real estate investment trusts, better known as REITs. What is a REIT? A REIT is a company whose business involves either the ownership or financing of real estate. For the purposes of this video, I want to specifically talk about equity REITs. Equity REITs are companies who acquire or build real estate. They lease out their properties to tenants and generate revenue by collecting rent. Now, there's two main reasons why I'm suggesting REITs as an investment for a recession. First of all, US REITs are legally required to pay out 90% of their earnings each year to shareholders as dividends. What that means is that by investing in REITs, you're guaranteeing yourself an investment that not only pays a dividend, but pays a very high dividend relative to its earnings. This is great for supplementing any loss of income that we experience during a recession. But the second reason why I believe that REITs will be a great investment for a recession is because they're resistant to inflation. Now, I know what you're thinking. Surely if we're in a recession, then we'll start to see prices come down. And you'd be correct for thinking that way, because typically when central banks increase rates, demand falls, and so does inflation. But two things are true. Number one, inflation pretty much everywhere globally is at multi-decade highs and will likely stay above the target rate of 2% for some time. And number two, there are supply chain constraints that central banks can't control, which could keep inflation high irrespective of rising interest rates, meaning it's good to have some hedges against inflation in your portfolio. Research shows that REITs outperform the broader market in times when inflation is moderate or high, and that's because both rental income and property valuations tend to scale in line with inflation. But before you go add any REITs to your portfolio, it is important to note that the points around consistency, scalability, and having solid dividend metrics are equally as applicable to REITs as they are to dividend stocks. Currently, Federal Realty Investment Investment Trust is the only REIT which is also a dividend king. Essex Property Trust and Realty Income are two more REITs which are classified as dividend aristocrats, which is the next level down from dividend kings. So those REITs might be a good starting point when trying to figure out what REITs might be best for you. So at this stage in the video, I just want to touch on some points around long-term investing. Even though knowing what not to invest in and what to invest in during a recession is important, it's arguably not as important as your behavior as an investor. Just like when times are good, there's a tendency for some bad habits to crop up in investors during a recession. For example, trying to time the market. Never a good idea. As the old cliche goes, time in the market beats timing the market. Bank of America found that going back to the 1930s, if you were to invest in the S&P 500 and hold that investment until today, your return will be 17,715%. But if you were to miss just the 10 best days in each decade, your return today would only be 28%. Point being, you're much better off just staying invested for the long term than you are trying to time the market perfectly. You might be tempted to hold off on your investing because stock prices are declining in the recession, but in reality, nobody knows where the stock market is going to go today, tomorrow, next month, or next year, and you really have to be in it to win it. You also want to avoid panic selling during a recession. The majority of people should only be investing for the long term. Most of you have absolutely zero business in day trading, and you should just stay away from it completely. After all, the vast majority of day traders end up losing money. So assuming you're a long-term investor, which in my eyes is someone who is planning on buying and holding for 30 to 40 years, then you have absolutely zero reason to panic during market declines in a recession. Take a look at the all-time chart of the S&P 500. The market always bounces back. If anything, you should see stock price declines as an opportunity to pick up some great companies at a discount. But selling your investments for no reason other than the fact that you're nervous is probably an indication that you made the investment without fully understanding it in the first place. Don't make that mistake. Have a plan and stick to it. So that's my thoughts on how to invest during a recession for beginners. Let me know what your investing plan is for the recession, and if you have any tips that I didn't cover in this video, make sure to leave them in the comment section. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers!